Welcome to Beanstalk, M&J's podcast where we are sharing and showcasing our areas of expertise through conversations with practice leaders on their knowledge and experience.
Welcome back to the Beanstalk podcast. Today I'm very excited to welcome back William Roberts, who leads our international tax practice. And today we're going to be talking about, what I would probably call, inbound 101, right? So, foreign companies coming in, investing in the United States, whether they're expanding or just investing, in whatever, we'll kind of go through the core concepts there, kind of the life cycle of that investment or that operation. And, whether it's choosing your entity, whether it's, figuring out if you've got taxable presence, operating it efficiently, and making sure you can kind of get your money home safely and efficiently, right? So we'll kind of talk through all that. And again, excited to welcome William here. Thanks for coming back.
Well, Brent, thanks for having me back. Appreciate it.
Yeah. I think the biggest starting point, I think, right, is like, hey, if I'm a foreign company, and I'm looking to invest in one way or another in the U.S., right? The first question is probably, well, how do I start? How do I structure myself? Like, what's the starting point?
Right. Well, just like any other starting point, even going outbound, you have to ask yourself, what kind of entity do I want to form to go into the U.S.? I mean, you can do several things, right? You can form a U.S. company and send your operations that way. You can not establish a U.S. company and just come into the U.S. under like a branch. You can set up a home office, or you can set up a sales, kind of center. You can even, just have traveling salesmen. So you don't have some sort of corporate entity, but you're here in the U.S., with touch points and boots on the ground. You can also form a domestic partnership, or you can be a foreign partnership doing the same thing as a corporation that doesn't have a U.S. corporate subsidiary. Mm-hmm. So you've got corporation, a branch, you've got a foreign partnership or a domestic partnership. So I think those are the three. Just your plain, generic kind of vehicles. Yeah. And there's LLCs and all that, but basically they all can get taxed one way or the other. Through the check the box rules that people are familiar with, you can treat those as whatever you want to for the most part.
Sure. So kind of walk me through what the differences would be, okay, right? As far as operationally, if I'm a flow through or a branch, or if I'm in the corporate setting, like how does that impact me, like from the income I earn in the U.S. and how I get the money out, right?
Yeah, I mean, and from just a pure choice of entity aspect, some people may think, well, if I set up a U.S. corporation, then I'm going to get taxed on whatever that U.S. corporation does as a foreign investor, and that's not the case, right? It's your standard double taxation. The U.S. corporation would be a standalone entity. It pays its own, it has its own operations, pays its own income tax, files its own returns. Yep. The only way that the foreign investor is going to be taxed on its U.S. income, so to speak, would be through a distribution from the U.S. corporation. So the standard,
what people kind of call a blocker.
Yeah, right. So it's two levels of tax standard, in most transactions. There's also, like I said, you can come in as a branch. That means you don't have an entity or a partnership. Mm-hmm. You basically just have operations here in the U.S. In that situation, you are taxed, depending on whether you have a U.S. traded business, which we'll talk about shortly, and whether then that is blocked by the treaty with the U.S. Depending on whether you have that, you are taxed immediately on that income, just like any sort of flow through. Same thing with a partnership. If you set up a domestic partnership and you are a foreign partner, you will be taxed immediately on your allocable share of the profits of the partnership. If you're a foreign partnership coming into the U.S., you're almost in the same situation as if you were a foreign corporation that wasn't in the U.S. So it's all is flow through except for the U.S. corporation standard.
So I mean, you kind of have the option of, hey, I can kind of allow the income to flow into abroad,
That's
or
right.
I can kind of trap it, so to speak, right, in the corporate setting, right, and maybe control the flow of funds back. And both are certainly applicable. I mean, there are certain situations where you'd prefer one over the other, right? I mean,
right.
Can you kind of talk through, hey, what's a circumstance where branch is better versus a blocker, or
right,
or an LLC, anything?
Right. And it's very subtle, and in a lot of ways, it's almost the same. Yeah. And the reason I say that is we talked about how the U.S. corporation, if you have a U.S. corporate standalone, subsidiary, foreign corporation is not taxed on that until a distribution. Mm-hmm. If a foreign corporation comes in the U.S. without setting up a corporation, a U.S. corporation, then you are a branch again. We've discussed that.
Yep.
But you are then subject to 2 levels of tax as well, because the U.S. doesn't want to give foreign corporations coming into the U.S. a distinct advantage over U.S. corporations owned by foreign corporations. So if you're a foreign branch coming to the U.S., you're subject initially to the 21% income tax rate as a U.S. corporation is. But just like I said, when you have those distributions, if you have a U.S. corporation standalone, you don't get taxed until you have that distribution. Mm-hmm. Under the branch rules, you could be subject to the branch profits tax. And what that is that's a 30% tax on what they call a dividend equivalent amount. So what that means is, to the extent you are taking your profits after the 21% income tax and you're investing your profits back into the business. In other words, you're increasing your U.S. assets, you're buying more tangible manufacturing goods, or buying additional warehouses or whatever. To the extent you're increasing your U.S. assets, then you are not subject to the branch profits tax. To the extent you are decreasing your assets and it looks like you're actually repatriating earnings back to the foreign country, that is a reduction, and that would be subject to the 30% tax. So
going back to what you said, is like they're kind of the same.
Yeah, they're kind of the same, right? It's you think it's like, we're going to set up we're not going to set up a corporation, we're going to set up a branch. Well, to the extent you look like you're repatriating income through the reduction of your asset base. Yeah. And because if you had $1 million of cash at the beginning of the year, at the end of the year you have $200,000. Well, and let's say that's your only assets, which obviously is very simple. But that would look like a repatriation of that $800,000, and that would be subject to 30%. Right. Treaties can reduce that to whatever rate the treaty says. So there's that. U.S. partnership. Let's say you're a foreign person, and let's just kind of skip foreign partnerships because that's kind of very similar. Sure. But let's say you're U.S. You're a foreign person investing in a U.S. partnership, and you think, well, I don't have a trader business in the U.S. It's my partnership that does. Well, that's wrong. Under the code and regs, the U.S. trader business or the U.S. activities of a domestic partnership are attributed to the foreign partner. Mm-hmm. And whether you get cash or not, you are taxed on your allocable share of the yearly profits, basically at either the 21% rate if you're a corporate taxpayer, or the 37% rate if the highest individual tax rate. Yep. So
let's dive into that a little bit. Like we've mentioned trader business a couple times, right? So what does that mean in this context? I mean, and why is that important? Like things to be thinking about where, hey, if I'm just investing in the U.S. or I have a trader business in the U.S., like why does that matter?
Right. Well, I mean, it's really kind of the keystone, the cornerstone of the U.S. tax principles in an inbound situation. And the reason I say that is because there's 2 options. If you don't have a U.S. trader business, you're more of a passive foreign investor, and you receive dividends, interest, royalties from your U.S. investments, and you're not really engaged in a U.S. trader business, then those are subject to what we call FIDAP, fixed determinable annual periodic withholding, 30% standard rate on the gross amount of such payment from the U.S. sources to the foreign person. Mm-hmm. And on the gross, not in the net. So if your U.S. tax liability would be lower than the 30%, then you'd have to file a tax return and get the money back. But you're still out 30% until or unless you do that. You may be like, well, I don't want to open up that can of worms. Let's just let it lie, right? So, but that could be reduced by a treaty as well. So you have that rate. So if you're a passive investor, basically gross basis withholding. But if you have a U.S. trader business, then you're subject to net basis taxation. So you have to file a U.S. tax return and pay taxes on that. And it's then you're subject now to the whole umbrella of U.S. taxation under the IRS. So.
And trader business isn't really defined, right? So it's like, I mean, what are the characteristics? Like if I'm trying to avoid that or get into that realm, right? So being a trader business, like what do I need to consider if I'm, if I have some characteristics of passive investment, but also an operating entity, like again, why is it important, and like how can I differentiate if what I have in the U.S. is a trader business?
Right. And unfortunately, U.S. trader business is not really defined in the U.S. code. Right. It's really been developed through case law over the years. For example, and when I say over the years, the seminal case in U.S. trader business is a 1941 case. So as our boys are fighting the war, the tax court is busy defining what constitutes a U.S. trader business. And this case is called Piedras Negras. It involved a Mexican radio station sitting just right across the border, and advertising, blasting its music directly into the U.S., and it received most of its money from U.S. advertisers. And so the IRS says, hey, that's a U.S. trade or business. Well, the court said, no, it's not, because all the capital of the radio station and all the services that are being provided are in Mexico. So therefore, it's not a U.S. trade or business. Now, this is actually not only just the U.S. trade or business, but it kind of set up under the U.S. sourcing rules, like, something foreign source or U.S. source. It was basically a reaffirmation or maybe an establishment of the fact that services are sourced to wherever they're performed, not necessarily where the recipient
might be.
not necessarily the market be or where you get paid, where your bank account is, but where the service is performed. So that set up the lack of physical presence, right? Then several years later in this century, there's been cases where foreign hedge funds have had a U.S. broker or U.S. agent that you think, oh, you're just going to trade on our behalf, and that's when we talk about trade or business, if you're just trading securities on your own behalf, that's not really a trade or business.
Right.
So that's why the foreign hedge funds were like, well, this person's just trading on our behalf. We don't have a U.S. trade or business. But this agent their U.S. agent went a little bit further than that. He was negotiating deals, structuring transactions, kind of like similar to like an iBanker type thing. And so the court said, well, look, we are going to attribute the actions of your dependent agent to you. So, Mr. Foreign Hedge Fund, Mrs. Foreign Hedge Fund, you are now, you are subject to U.S. tax because you have a U.S. trade or business. Right. So that kind of, started swinging the other way and kind of standing for the proposition that if you have somebody working on your behalf, if you're a foreign person, you have somebody in the U.S. working on your behalf, negotiating and concluding contracts, structuring deals, and that's pretty much going to make you, have a trade or business. And that also, and we'll talk about how permanent establishment, that is also a concept, dependent agency gets into establishing a permanent establishment. But so the reason I offer those two kind of extreme examples is I guess the key takeaway is just like any sort of like a state and local taxation similar nexus analysis, it's how many contact points do you have in the U.S. It has to be considerable, continuous, and regular. So if you come in and you set up a small deal one time, maybe twice a year, that
wouldn't be continuous.
Yeah, it's not continuous, and depending on whether it's considerable and regular, so you have to have touch points, boots in the ground. So every time, as a foreign person, if you're worried about establishing a trade or business, think about what are you doing in the U.S. and every time you keep on adding another layer of activity in the U.S., you are subjecting yourself to a potential treatment of trade or business.
Yeah, that makes sense. And then that ties into, hey, if I've got a trade or business here, well, now all of a sudden I've got effectively connected income to the U.S., right? And you mentioned permanent establishment. I mean, how, kind of talk through, once I have a trade or business and I have effectively connected income, and what do I need to be considering then?
Right.
As I operate, or as I just from a cash flow perspective.
That's right. And so let's say you've established the U.S. trade or business. At that point, you can have the foreign person's U.S. activities are all attributed to that U.S. trade or business. And there's an example in the regs where I think it's, if I get this backwards, whatever. But there's a U.S. company, the foreign company goes into the U.S. and it sells electronics, right? And so it's got all that business going on, U.S. trade business. But it also, because it's got touch points and continuous, considerable, regular, all that, it also sells wine into the U.S., directly into the U.S., from the foreign country, which is not really part of its electronic business, but because it already has a U.S. trade or business, that wine business and that electronic business get put together as all the ECI income that they have, and so all that's subject. So seemingly, hey, we're in France, we're selling wine to the Americans. That's not taxable because we're not doing anything.
Because we're not over there. We're not.
They're just calling us up. Yeah, we're just shipping them. So, but that's because you have that U.S. trade or business already. That's pulled in. So that's really the danger here of establishing U.S. trade business. The force of attraction rule, attracts all your U.S. activity.
So can you structure your way around that circumstance, right? Where I've got, one activity that has no touch points, right? Or, I'm just shipping in and then I have another activity. Like, can I segregate those? There are ways to structure yourself around that?
Right. I mean, there are definitely ways to do it. And I would actually bifurcate it, and I would, if under a treaty, if you have under a treaty, if you don't, let's say the wine business, if you don't have a permanent establishment in the U.S. under the treaty, then that business income is not subject to U.S. taxation. Now, again, if you have the electronics and you have a dependent agent and you're selling all the goods and services from a fixed place or business, then you are subject there. But really, the permanent establishment is under the treaty. It prevents you from being taxed in the U.S. because we work with clients all the time that they have U.S. activities. They sell or do a decent amount of services here in the U.S. But because they have no permanent establishment here, they're not taxed on it. So what is a permanent establishment? Permanent establishment is basically a fixed place of business, an office, kind of a bricks and mortar type operation. And we're not talking about a permanent establishment is not the same thing as your U.S. subsidiary, if your U.S. corporate standalone subsidiary. So by you setting up a U.S. corporate subsidiary, that is not the same thing as having.
It's not by default establishing
that's
permanent.
Right. That is not a permanent establishment. That is not attributable to you. We're talking about here a foreign entity person coming in and
boots on the ground.
Boots on the ground, bricks and mortar operations, and also the dependent agent. Right. We talked about in the foreign hedge fund having the dependent agent. If you have people coming over to the U.S., whether they be salesmen and they're going around the country negotiating sales contracts, approving them, setting up deals, that dependent agent is going to give you a permanent establishment. If you have sometimes even independent agents, seemingly independent agents can be treated as dependent agents based upon the independent contractor type versus employee type versus dependent agent type situation. A lot of factors go in there. If you think you may be doing something like this, definitely talk to your tax advisor before you do stuff like that, because once you get that permanent establishment, game's over. You got to file.
Yeah.
But if you don't have one, say you don't have a bricks and mortar operation, say you have traveling salesmen and they're selling $1 billion worth of goods into the U.S., but they're just setting up demonstrations, but all the contracts are being negotiated and approved back in the home office in the UK or France or Malaysia or wherever, then that is not a permanent establishment and you're not taxed on that income coming to the U.S. Now, in order to do that, though, you have to, we file a protective tax return, basically. And what that does is we file a tax return with not a whole lot of information on it, but there's a treaty-based return position statement that says, okay, look, we have this activity in the U.S., but under the treaty, under this provision, that provision, we are not, our activities don't rise to the level of permanent establishment, and that way you're protected.
So you're basically filing to say, hey, we don't think we have any obligation to pay tax here, and the filing helps, I guess, start the clock, right? Where it's like, if you don't file anything, then the U.S. could come back at any time, in any point in history, right, and just say, hey, we think 2018, you guys owed this tax, and
that's right.
And but doing this filing helps just kind of protect yourselves as based on the position you're taking, right?
That's right. Yeah. So again, the default rule is if you're in the U.S. and you're conducting activities that may look like a trade or business, as long as you don't have a permanent establishment and you tell the IRS you don't have a permanent establishment protective, then that's not a slam dunk per se, but it's a lot better than them finding out and then saying, hey, we think you have a U.S. trade or business. Then you having to go through and try to establish that you did not have a permanent establishment. So we like to do that, get it out in the open, say we don't think we have one. It saves everything. And plus, if you don't file that elective return, then you don't get to take deductions. So it's a real.
So not only
can
the IRS go back, but they can just say, hey, here's your gross revenue from the U.S. and you don't get deductions.
That's right. So you preserve deductions, and it's definitely something you want to do if you think you're even close, or if you think because the IRS may disagree with you, and if the IRS disagrees with you, then you got court, and for some reason it doesn't end up in your favor. Hey, at least if you file a protective return, at least you can file a full-blown tax.
It's worth the nominal fee.
It's worth the nominal fee
for the peace of mind. That makes sense.
And the thing about treaties, though, too, is not every country. We don't have a treaty with every country. We have about 66, 67 or so treaties, and so. If you're in that treaty, then you can take advantage of the PE analysis. But let's say you're from a South American country or a Central American country, then you don't have any protection from the U.S. trade or business analysis.
Well, let's talk through that. Like, what's the scenario where from a country where where there is no treaty versus a country where there is a treaty. I have permanent establishment. Like, what could the difference be there?
Right. Okay. Let's say you're from Colombia, and you have a pharmaceutical business in the U.S., and you have salesmen coming in selling your products, your Colombian products, and they're concluding they're selling the goods, right? They're in the U.S. selling your Colombian.
We have a trader business.
Right. You have a U.S. trader business, right? You are then subject to, you have to file a tax return, you have to pay taxes on your income, deductions, the whole thing. It's just as if you were a U.S. corporation, right? And you could be subject to all different layers of taxes. Now, let's say you're from France and you're selling your pharmaceutical goods into the U.S. You have traveling salesmen, but they're selling $1 billion worth of products, right? It's a big gang busting kind of industry. Well, because you were smart and you said to yourself, okay, well, I'm not concluding contracts, and maybe the Colombians were smart too. They maybe even said, well, our Colombian keepers have to approve these contracts. Same thing in France. Well, in that situation in Colombia, they have the U.S. trader business. They're stuck. The French can then say, well, we don't have a permanent establishment, even though we're selling $1 billion worth of our pharmaceutical goods in the U.S. We don't have a permanent establishment, so therefore we don't have to pay taxes on it. We don't. Right. Even though we have a U.S. trader business, so then you file the protective tax return and you're done. 21% tax rate here in Colombia, no tax rate here in France.
Got it.
So that's how a treaty would really kind of helps treaty countries.
Yeah, and you know something in there that it's just like something so small as hey, we complete contracts here.
Right.
Like, is that what's creating like maybe the trader business or a permanent establishment? Like, can you help me delineate the two?
Yeah, and that's the thing. From a U.S. trade or business perspective, yes, a dependent agent coming in and concluding contracts does give you a U.S. trade business. Unfortunately, even under a treaty, concluding contracts, negotiating contracts, executing in the U.S. is the same thing. It is a permanent establishment. Yeah. So what the best practice is to if you're going to have people coming over to the U.S., have them. You can sell your goods. You can even talk about what your price terms are. Here's if you buy this amount, you'll get this price. If you buy this amount, you get that price. Do demonstrations. You can set up a warehouse that once the sales get approved, you can ship it to your U.S. customers. But all the negotiating for price and all the execution, approving a document has to be overseas. And that way, that avoids permanent.
Well, I think that's a good takeaway, right? It's like how nuanced these laws can be just flip that switch, because like you mentioned earlier, it's like once you flip the switch on permanent establishment, you can't really go back. And, just for our listeners, right, just being aware of, hey, we want to make sure that you're taking advantage of your treaties and not creating PE where you don't have to, because there are some real important implications of all that. So let's go back to, I guess, kind of repatriation. You kind of mentioned treaties.
Right.
I guess what's kind of the standard, what countries do we have favorable treaties with? I mean, what's generally going on there? Right.
Well, and this will go back to the beginning of the conversation we had, where you have the two roads you can go down to, right? If you're the passive investor or you're you have the U.S. trade business. So let's start with the easy one first. You're a passive investor. You bought some stock in a U.S. corporation. You are getting dividends, or you made a loan to a corporation, and you're getting interest back from that. Well, if you're in a treaty country, a lot of times the FIDAP withholding rate, the 30% gross basis, is reduced anywhere from 15, 10, 5 down to 0, depending on if it's a dividend, for example, how long you've owned
this, how much of the company you might own.
Right, how much you own, how long you've owned it, whether you meet all the treaty aspects too. And that's kind of, I don't want to really gloss over that fact, because in order to get that treaty rate, you have to meet all the tests under the treaty. If you're a foreign individual, generally you're going to meet those. If you're a publicly traded foreign corporation, generally you're going to meet those. But if, let's say, you're a closely held private corporation in a foreign country, you not only have to meet, 1, that you're a resident of that company, 2, that you don't have a permanent establishment of that country, 3, that you meet the applicable article relating to like for dividends, for example, say you have if you are looking for the zero rate, then you generally you have to own it for longer than 12 to 18 months. You own 80%. Take your pick, but you have to meet that one as well. And then you have to meet what we call a limitation on benefits treaty, which says, okay, you're the beneficial owner of that, right? And there's all kind of content. I don't want to get into all the specifics, but basically, we have to be sure that you are the person that is going to be receiving these benefits. Like if you're a closely held corporation, for example, then it's all the investors in that closely held corporation are citizens that would otherwise apply and receive treaty benefits on their own, right? Yeah. So you can't just say, "Oh, we set up a corporation or a partnership in France, but we're all our Colombian pharmaceutical reps," right?
Right.
So you can't route money, because we don't have a treaty with Colombia. You can't route your Colombian pharmaceutical profits through France, right? So those are the kind of things you have to think about when you're setting up, applying for treaty benefits. So that's definitely before you start doing something, you want to talk to your tax advisor. Yeah. But so there's that applying for the treaty will help you reduce those rates. So that's the passive investor. And in order to apply for these, again, there's always forms.
Right. I was going to ask about that. Yeah, the compliance piece of this,
right,
and the withholding piece of this, and I mean, there's a lot to consider as you, right. Basically every cash distribution, you got to be thinking, hey, do I have, unless my treaty benefit is 0% and I'm filing appropriate forms, like I'm withholding to some degree and I'm reporting to some degree, and you got to be thinking about that every time you send cash abroad, right?
That's right. And basically, as a foreigner, you want to send the payer of that U.S. source income a form that says, "Hey, I'm a foreign person. Mm-hmm. I meet the treaty rules. I meet all tests." And then you give it to the foreign person. Gives it to the U.S. person. The U.S. person looks at it. If they can rely on it, then they they withhold depending on whether they actually think they meet the treaty rates, and then. It's kind of like a 1099 W-2 type, 1099 situation. At the end of the year, the payor will give you a form that says, "Okay, here's what we paid you. Yeah. Here's what we did or did not withhold." Right. And if you're a FIRPTA person, and you don't have a treaty, that's 30%. Mm-hmm. And if you look at if you think about what your tax rate might be. If you just filed a U.S. tax return and it's like 10% as opposed to 30%, and we're talking about a lot of money, then it might behoove you to file a U.S. tax return and say, well, look, you withheld $30 million, but you should have only withheld $10 million. So I want my $20 million back. If it's $3,000, that may not be a big deal for you, and it might not be worth it. But so there's that. Now, if you have a U.S. trade business, you are not necessarily subject to withholding under the general typical ECI rules. And why I say that is, let's say you are you have a U.S. trader business and you are part of an entity that has a U.S. trader business, and you're getting payments from them. If you say, well, this is part of my U.S. trader business, you file another form that says you don't withhold on me because I file a U.S. tax return anyway. Or let's say you get like a dividend that would otherwise be FDAP income from a company, or interest from a company, or royalties for a company, but you have a U.S. trader business already. You just give them a different form that says, hey, don't withhold on me, but you still get the same kind of 1099 type form at the end of the year, but that goes into your U.S. tax return. So there's that. Mm-hmm. If you invest in a domestic partnership, however, as a foreign person, then you're subject to taxation immediately on at the end of the year based on your allocable share, and they withhold on that depending again whether it's the 20% corporate rate or the 37% individual rate.
I feel like most people will try to structure to avoid that circumstance, right? Where you're just constantly withholding 30% on a flow-through entity share of a foreign partner. Right?
That's right. I mean, yeah. If you're smart, and and I'm not saying the people that don't do it are dummies, but if you're thinking about what you're going to be doing in the first place, you need to think about, okay, can I apply for the treaty? Mm-hmm. If I don't, and if you're, like I said, if you're a Colombian pharmaceutical company, there's only so much you can do. In which case, you may think about setting up a U.S. trader business. You may think about not setting up a trader business, but
well, it all connects, right? It's like it's not only how do I structure on the front end, it's how operationally and administratively how do I do it, and then on the exit, it's all got to kind of all the dots have to be connected, right?
That's right. So yeah, and you hit the nail right on the head. You're coming in the U.S. for a reason, right? You're not coming in the U.S. just because you want to have a board meeting in Las Vegas.
Right. That might be part of it.
I mean, that definitely might be part of it. But you're setting up an operation here because you think you're going to make money. Well, and you want that money back at some point, right? So you have to ask yourself, okay, what's going in, what's my repatriation strategy, and then what's my exit strategy. Different kind of things depending on what entity you have, and whether treaties apply. All so a lot of stuff you got to think about as you're going to the U.S. and repatriation and profit is one of them.
Yeah.
But yeah, even if you do something like, well, I want to buy a nice, lovely building, I want to buy a nice, lovely building in South Florida, right? I want to use it for a little while. I want to maybe rent it out, or I just want to have it as a nice home. And then, for a couple of years while my kids are going to school, and then I'll go back to, wherever country I'm from.
Yeah. Well, you're getting into different rules now,
Right.
We should switch gears here and talk about, real estate, investment in real estate from a foreign perspective, because I know that's kind of its own little world. Do you want to talk a little bit about, kind of the history of, the real estate, kind of provisions and all that, FIRPTA,
Right, yeah, absolutely.
Yeah.
You mentioned FIRPTA. FIRPTA is the Foreign Investment in Real Property Tax Act.
That's right.
All right. It's a silly name, right? FIRPTA. But it wasn't a silly concept. And for, the viewers out there, or the listeners out there that are about my age or older, they remember back in the 1980s when, the Japanese were selling cars like crazy, selling electronics like crazy, and they had all this money. They had nothing to do with it. There's only so much you can buy in Japan, and so they started.
U.S. real estate starting to look pretty nice, like a nice investment.
That's right. I've always wanted to live in South Florida when I leave, cold northern Japan, right? So, there a lot of Japanese individuals and companies were buying, real estate in the U.S., buildings, condos, whatever. And when they went to sell them, they weren't really paying taxes on that. And so that kind of got, raised the hackles of a few congressmen and women. And so they decided, well, we don't like that. That's not fair.
Yeah.
So they set up this FIRPTA regime to where if you are a foreign owner of U.S. real property interest, not necessarily, let's keep on going, real property interest, and you sell that, the U.S. buyer has to withhold 15% of the gross proceeds and remit it to the IRS, and the foreign person gets 85%. Well, if really, because if you think about it, the selling of property is a capital gain, right?
Right.
And so why would you withhold all this? I don't have. Why are you withholding on this? Well, FIRPTA, what it really does, it does two things. One, it makes the sale of U.S. real property interests treated as a U.S. traded business. So that's the thing. A lot of people just think it's just a withholding provision, but it is that. But it's not only that. The real bite of the FIRPTA is the fact that you are now, by selling that U.S. real property interest, you have a U.S. traded business, and because you have a U.S. traded business,
Now you're subject to
U.S. tax.
regime. That's right.
Well, back in the day, you're this, when we didn't have internet and we couldn't hunt you down or Google your address and find out exactly where you live. These people could be like, well, I'm in northern Japan. Come find me.
Right.
So that's why they implemented the withholding tax. And so that's why the U.S. person has to withhold. And then it's just buyer beware, too. If you're the U.S. person and you don't even know that the person you're buying it from is a foreign person, and you don't withhold that 15% tax, and you're subject to that, the taxes and penalties and interest on that, just as an aside.
Right.
But for the foreign person, you get the sale of U.S. real property interest is a U.S. traded business and is subject to withholding at 15%. So what is the U.S. real property interest? Basically, it's land, buildings, mines, that kind of thing. And so people are saying, well, okay, well, that's great. Well, I'm going to do something different. I'm going to have a U.S. company buy the land, and once it appreciates in value, I'm going to sell the stock of the U.S. company as opposed to land. Well, guess what? That's capital gains. Capital gains sourcing rules are to the source to the
sometimes
location.
that can be 0% back home, right?
Right. Sometimes it can be 0%. So again, no, they weren't happy with that either, which makes sense. I wouldn't be happy with it either if I was a similarly situated individual. So what they said is, okay, a share in a corporation that owns greater than 50% of its assets basically is our U.S. real property interest. You are considered a U.S. real property holding corporation, and the stock of that U.S. real property holding corporation is a U.S. real property interest. So therefore, a foreigner that goes to sell the stock, the buyer of that stock has to withhold the 15%.
Yep.
So they shut down that workaround. But so basically, if you're investing in U.S. real properties, or you're investing in a corporation that invests in real properties, then you are subject to these FIRPTA withholdings.
Are there any structures or strategies to minimize that or avoid it, or just take the scenario where I sell the real estate and I own it through a corporation, I sell it, and then 2 years later, I liquidate the company back. I mean, is there anything in there that avoids some of this, this intended thing from FIRPTA?
It does. And if in that situation, and then there's look back rules and all the good stuff. We won't for the purposes of this conversation. Yes, if you have a U.S. real property holding corporation and it goes to sell all its U.S. real property interest, it can still have foreign real estate interest, and it can still have other U.S. assets. But as long as that threshold comes below 50%, and basically you sell your U.S. assets, right, your U.S. real property, then you're not a U.S. real property holding corporation at that point. Yep. And then you can sell the stock at its capital gains. You're not subject to FIRPTA, or if you want to liquidate the company at that point, it becomes either a taxable or non-taxable liquidation. Sure. So that's a real legitimate way of doing it. Yep. People are also thinking about, well, let's set up a partnership interest partnership that buys the real property, and I'm the foreign person. I'm like, well, guess what? I'm not going to sell the U.S. real property. I'm going to sell my I'm going to sell my interest in the U.S. partnership. And so that's, even though the interest in the U.S. partnership is not a U.S. real property, the sale of a U.S. property, U.S. partnership interest that holds real property, that is basically
it keeps looking down.
Yeah, it's not a U.S. real property interest, but that sale is now a U.S. trade of business, an ECI. So you got to go through the same thing. So there's that. Now, recently, I think it was either earlier this year or later last year, but recently, they've created an exception for a qualified foreign pension fund. And what that is it's a foreign pension fund. A bunch of pensioners get together, they put their money into this fund, or a company sets one up or whatever, and they start investing in U.S. real property. Well, qualified foreign pension funds are not subject to FIRPTA withholding, are not subject to FIRPTA. So it's created a real incentive, and it's really now, as of late, the primary investing vehicle through which you would invest in as a foreign person would invest in U.S. real property. So and then if you're a foreign government, you're not subject to FIRPTA either. But so there are definitely ways, like I've never really thought about this, but I don't know if our little Columbia friends, our pharmaceutical company down there, if they
love these guys,
if the Colombians, set up if they start investing in foreign real estate, I don't know if they would be not subject to FIRPTA, but I don't think they are. But irrespective, if you are a qualified foreign pension fund, and we don't need to go on that for purposes of this, but if you have that, if you're one of those and you establish one of those, then you're not subject to FIRPTA.
Okay.
So,
as we wrap up, is there anything else you want to talk about? I mean, I know, there's the Corporate Transparency Act was out there. I think feel like that went away. But anything else for the listeners to kind of think about as they're investing inbound and reporting, or just operating anything?
I would think, find out, what entity, again, key takeaway points. What entity do you want to invest in? And then think about, are you going to be establishing a U.S. trade of business? If you're going to be establishing a trade of business, is there a way for you to not create a permanent establishment under a treaty if you're involved in a treaty? And then think about filing protective returns, or if you are not from a treaty country, think about, how can I minimize this? Because once you're a U.S. trade of business, I mean, let's go with the harshest scenario. If you're not from a treaty country, you have a U.S. trade of business, then you're subject to the U.S. tax laws. Now, that's if you knew that coming in, you'd be subject to tax at some point if you don't have a treaty. But you also have your U.S. tax advisor who can help you avoid, or not avoid, but mitigate your taxes and your reporting requirements and all that. So yes, you are in the taxes, but there's a lot of qualified, U.S. tax advisors that can help you minimize and mitigate your taxes. And then I guess the last thing is, if you don't, irrespective of a passive foreign investment, we've kind of beat that up. But the thing also you got to think about too is, okay, so this is all we're talking about, nothing but federal taxes, but the state taxes are a huge consideration beyond the scope of this. But just suffice it to say that just because you avoid maybe federal taxes, the states don't necessarily have to conform to the federal tax treatment of this. Like California basically tells the U.S., to go fly a kite all the time. So if you're going into California, well, then just be prepared to
have separate battles.
Yeah.
Well, I mean, just take an operating business that operates in all 50 states. Now you're not just federal; you're in 51 different jurisdictions that all might have different rules and just things to consider. So
that's right. And also people think, well, the treaty. I've got the treaty, even if I'm from a treaty country. No, the treaty only applies to federal taxes.
Right.
The treaty does not apply to state and local taxes, city and municipal taxes, that kind of stuff. So tariffs, that kind of thing. So
plenty of layers.
Right, plenty of layers. So
yeah. Well, I think this has been great. It's just a small bite of the apple that is inbound taxation, and so I look forward to probably diving deeper into this later on. But I think this has been very helpful, and I hope everybody else listening got something from this. And like I said, I think we'll take deeper dives, but just kind of a little taste of what it's like to come in and invest as a foreign investor in the U.S. William, thank you for joining us.
Thanks, Brent.
All right,
Enjoyed it.
Thank you.